Welcome to the deep dive. If you're tuning in, you're probably trying to figure out the Toronto real estate market
Right.
and maybe how the Bank of Canada's policy rate plays into your decisions.
Exactly. Especially if you're working with someone like Bradley T. Cox, focused on that informed, guided approach.
Yeah, absolutely. So today, we're really zeroing in on that. The Bank of Canada's current rate, what's driving it, and, the real impact here in Toronto as things stand in early May 2025.
Precisely. We've looked at analysis from the bank itself, TRREB data, what the big banks are saying, economic news, all pointing towards, well, a lot of uncertainty right now.
Significant uncertainty seems to be the theme. So our mission today, kind of aligned with that bespoke approach, is to really boil down what you need to know, understand the now, and maybe think about what can happen next for your own plans here in Toronto.
Well said.
Okay, let's dive in. What's the current situation? What's the bank's key interest rate right now?
Okay, so as of their last announcement, that was April 16th, 2025, the bank decided to hold the policy rate steady at 2.75%.
Held steady. But wasn't that after a whole series of cuts?
It was, yeah. That's what makes it notable. It came right after 7 straight rate cuts starting back in mid-2024.
7 cuts. Wow.
Yeah, a total drop of 225 basis points. That's down from a peak of 5.00%.
So quite a big shift downwards and then a sudden stop. Why did they hit pause?
Well, the bank was pretty clear on this. The main reason was what they call extraordinary uncertainty, and that's mostly coming from escalating and really unpredictable U.S. trade policy.
The trade issue. So that's injecting a lot of instability into their outlook.
A major element, yes.
Yeah.
These decisions don't happen in a bubble, right? Global factors are weighing heavily.
So external factors are really driving the bus right now, maybe even more than domestic signals.
That's exactly it. Governor Tiff Macklem even said something like, the future is really no clearer.
Not exactly reassuring.
No. So it's led them to be, well, very cautious. Data dependent. They're being less forward-looking than usual, as they put it, until things become clearer.
Interesting. And this pause happened even though some things here at home, like maybe inflation or the job market, might have pointed towards another cut.
Right. Headline inflation was moderating. The labor market actually weakened in March. Things that might normally suggest more easing, it really shows just how much those external trade worries are dominating their thinking right now.
Okay, so given all this trade uncertainty, how is the bank even trying to plan ahead? It must be incredibly difficult.
It is. And it led them to do something pretty unusual in their April monetary policy report, the MPR.
Unusual how?
Well, normally they give one main forecast, right? A base case. This time, because of the trade situation, they presented 2 distinct scenarios.
2 scenarios instead of one. That definitely signals how uncertain things are. What do those scenarios look like?
Okay, so scenario 1, they called it limited tariffs. Basically, it assumes the U.S. trade actions affecting Canada don't get too out of hand. Under that view, they expect, a temporary dip in Canadian growth, but possibly a recovery later in the year. And inflation would likely stay around that 2% target, kind of a manageable bump in the road.
Okay, manageable. A short-term slowdown, then back towards normal. What about the second scenario? Sounds like it might be worse.
It is, yes. Scenario 2 imagines a protracted trade war, so more widespread, longer-lasting trade disputes involving Canada, maybe other countries too.
And the impact.
The bank's analysis suggests that could push Canada into a recession sometime in 2025.
A recession, wow.
Yeah. And interestingly, even with the economy slowing down, they think inflation could actually rise temporarily, maybe above 3% in 2026.
How does that work? Slower economy, but higher inflation.
It seems counterintuitive, I know. But it's because of the direct cost of the tariffs pushing up prices for imported goods, plus disruptions to supply chains. So, prices go up, even if demand is weak.
That's quite a contrast between the two possibilities.
Yeah.
Really highlights the risks depending on how trade plays out. The bank must be walking a tightrope.
Absolutely. And they stressed, these are just 2 points on a whole spectrum of possibilities. The uncertainty is still incredibly high. It makes giving firm guidance really, really tough for them.
Okay, so for anyone tracking this, when are the next chances to hear from the bank? What are the upcoming announcement dates?
Right. They have a set schedule. For the rest of 2025, the dates to watch are Wednesday, June 4th.
Okay, that's coming up soon.
Then Wednesday, July 30th. And that one comes with a full NPR, so more detail. Then September 17th, October 29th, another NPR date. And the last one for the year is Wednesday, December 10th.
Got it. Several dates to keep an eye on. And they said they plan to proceed carefully, right? So what specific things are they watching most closely to make those decisions?
They're looking at a whole mix of economic crosscurrents. Let's start with inflation. Headline CPI, the main inflation number, actually moderated a bit in March, down to 2.3% year over year.
Okay, 2.3%. That sounds
Better. It was lower than they expected, yeah. Mostly because energy and travel costs came down, but, it's never quite that simple.
there's always a but.
Always. There were things pushing the other way, too, like the temporary GST-HST break ended mid-February, so that added a bit of upward pressure.
All right.
And the bank really focuses on what they call core inflation measures, like CPI trim and CPI median. These try to filter out the really volatile stuff to see the underlying trend.
And how did those look?
They were stickier, still hovering around 2.8% to 2.9% year over year in March. So underlying pressures are still there.
And I guess housing costs are still a big factor.
Huge. Shelter costs were up 3.9% year over year in March. That's driven by, well, high mortgage interest costs, obviously, but also persistently high rent.
So looking ahead for inflation, it sounds messy.
Very. You've got the federal carbon tax removal from April 1st, which should pull headline CPI down, mostly via gas prices.
Okay, downward pressure there.
But then you have the potential tariffs we talked about, which could push prices up on all sorts of goods. The net effect, honestly, it's pretty uncertain right now.
So inflation is cloudy. What about the wider economy? How's growth looking?
We're definitely seeing signs of a slowdown. Real GDP actually shrank by 0.2% month over month back in February, after a stronger January.
A contraction. Was that just one sector?
No, it was pretty broad-based. Hit goods producers like mining and construction, but also services. Early numbers for March suggest maybe just tiny growth, like 0.1%.
So overall, Q1 growth probably slowed quite a bit.
Looks like it, yeah. Probably came in around 0.4% annualized, a significant deceleration.
And is this slowdown tied back to the trade worries?
The banks certainly think so. They said in April that trade uncertainty seems to be making consumers and businesses more cautious, holding back spending. Most bank forecasts are also pointing to pretty modest GDP growth for Canada for the rest of 2025.
Okay, economy slowing, inflation still tricky.
Right.
What about jobs? The labor market is always key.
Yeah, and the labor market, which had been really strong for a long time, showed some significant weakening in March. Employment actually fell by 33,000 jobs.
Bell. That's the first drop in a while, isn't it?
First monthly drop since January 2022, and the losses were concentrated in full-time work, which is notable.
So what did that do to the unemployment rate?
It ticked up to 6.7%, first increase since November 2024. The employment rate fell too. We're even seeing signs that wage growth might be cooling off a bit.
And any signs of longer-term issues?
Yes, actually, long-term unemployment has increased quite a bit compared to last year. The bank directly linked this labor market disruption to those trade tensions, saying businesses seem hesitant to hire right now.
Makes sense. If you don't know what your cost or demand will be, you hold off on hiring.
Yeah.
How are everyday people feeling about all this consumer confidence?
It's taken a massive hit. The Conference Board's index just plunged in March, hit a historic low, actually.
Historic low. Wow.
Yeah. Record pessimism about jobs, about personal finances. It's not just a little dip. People are really anxious. And for you, thinking about buying a home, that kind of pessimism often means people just aren't willing to make big financial commitments. It puts a damper on housing demand.
And businesses? Are they feeling any better? Their sentiment impacts investment, hiring.
Just as gloomy, unfortunately. The CFIB's Business Barometer, their long-term index, also crashed to an all-time low in March, even lower than during past crises like the financial crisis or the pandemic.
Lower than those.
Yeah. And the CFIB said it's directly because of the trade war uncertainty. Businesses just can't plan. Hiring intentions actually turn negative.
Negative hiring intentions.
Now, there was a bit of a bounce back in the CFIB index in April, but it's still deeply pessimistic. This collapse in confidence, both consumer and business, is a huge drag. It really suppresses spending and investment, and it might even be canceling out some of the boosts the housing market should have gotten from those earlier rate cuts.
It really sounds like confidence, or the lack of it, is a major headwind the bank is fighting against. Okay, so considering all this, the pause, the uncertainty, the slowing economy, what are the big banks forecasting for rates for the rest of 2025?
Right, so despite that pause in April, the general feeling among most financial institutions is that the Bank of Canada isn't done cutting rates this year.
Oh, interesting. More cuts expected.
Yeah, the consensus is pointing towards probably another 50 to 75 basis points in cuts by the end of 2025.
So that would take the policy rate down too?
Potentially into the 2.00% to 2.25% range.
Yeah.
Banks like RBC, CIBC, TD are sort of clustered around that 2.25% mark. Some think the next cut could even be at the June meeting.
Shoot, okay.
BMO and National Bank are maybe a little more aggressive, suggesting rates could get closer to 2.00%.
Any outliers?
Well, Scotiabank recently changed their tune. They now think the bank might hold steady for the rest of this year, but then start cutting in 2026.
Okay. And what are the markets pricing in? Sometimes they have a different view.
Market pricing, like from overnight index swaps, is also generally expecting about 50 to 75 basis points of cuts this year, and they're seeing a pretty high chance of a cut in June. So banks and markets are mostly aligned, maybe slight differences on timing or exact endpoint. The overall expectation is lower rates ahead.
Okay, so if the policy rate does drop further, how does that translate into mortgage rates for people in Toronto? That's the bottom line for many listeners.
Sure. Variable rates are the most direct link. They usually follow the bank's prime rate, which follows the policy rate. So if we see those B2 cuts, prime rates could fall to maybe the 4.2% to 4.45% range by year end.
And that means variable mortgage rates could go.
Advertised rates for competitive 5-year variable terms might dip to around 4%, maybe even a little below.
Okay, some potential relief there for variable holders. What about fixed rates?
Fixed rates are different. They're tied more to government bond yields, which reflect broader economic confidence and inflation fears. Given all the uncertainty we've talked about, fixed rates are likely to stay a bit higher, probably still above 4% for a benchmark 5-year term, even if the bank cuts again.
So the gap between fixed and variable might shrink.
Exactly. Which could make fixed rates look relatively more appealing, especially if you prefer knowing exactly what your payment will be, less risk.
Makes sense. Do we know what the best rates are right now, roughly?
As of early May, the lowest advertised insured 5-year fixed rates, that's usually for smaller down payments, were around 3.74% to 3.84%. Uninsured rates were a bit higher, maybe 3.98% to 4.09%.
Okay, good context. So variable might see more relief, fixed might stay stickier. Let's pivot directly to the Toronto market itself. What's the picture on the ground right now? Sales prices.
Well, the spring market got off to a pretty slow start this year. March sales were actually down sharply 23.1% compared to last March.
Wow, down over 23% year over year.
Yeah, even though sales usually pick up from February to March seasonally, in fact, the whole first quarter of 2025 was the weakest Q1 for sales in Toronto in about a decade. Demand has definitely cooled.
A decade. Okay, so with sales down that much, what's happened to the prices?
We're seeing some softening there, too. The average selling price in March was just over $1.09 million. That's down 2.5% from last March, though it was up slightly from February.
And the HPI benchmark. That often gives a clearer picture.
Right. The MLS HPI composite benchmark was down more clearly, fell 3.8% year over year, and also dipped 0.5% just from February to March.
Are all property types seeing similar price moves?
Not exactly. It looks like detached and semi-detached homes have held up a bit better, with smaller year-over-year price drops compared to freehold townhouses and especially condo apartments. Condos seem to be seeing slightly larger declines.
Interesting. So buyers might have more choice, maybe more bargaining room. What about inventory? How many homes are actually for sale?
Inventory is way up. New listings in March surged almost 29% compared to last year.
29% jump in new listings.
Yeah. And the total number of active listings homes actually available for sale has nearly doubled year over year. It's at multi-year highs.
Doubled. Okay, so lots more supply.
Exactly. And when you combine that surge in supply with the weak sales we talked about, the market balance has really shifted towards buyers.
How do we measure that shift?
A key indicator is the sales to new listings ratio, or SNLR. It plunged to just 29% in March. Anything below 40% usually signals a buyer's market. Plus, homes are taking longer to sell. Average days on market is up from last year.
So more listings, fewer sales, softening prices, longer selling times. It sounds like affordability might be getting a bit better, technically speaking.
Technically, yes. On paper, affordability has improved compared to a year ago because prices are a bit lower and borrowing costs came down from their absolute peak. But it's improvement from a really, really tough starting point. Homeownership costs in Toronto are still incredibly high relative to incomes for most people. And perhaps more importantly, that theoretical improvement isn't really boosting sales much because of that negative sentiment, the economic anxiety we discussed. Trade worries, job security fears. It's making potential buyers hesitant. They're taking a wait-and-see approach.
That confidence factor again. What about the rental market? Does that tell us anything?
It does. The rental market in Toronto is also shifting noticeably. It's becoming much more tenant-friendly.
How so?
We're seeing vacancy rates climb. Urbanation reported 3.5% for newer purpose-built rentals in Q1. Live.rent had it at 2.7% overall in March. And average asking rents. They're generally down year over year according to multiple sources: Urbanation, Live.rent, Rentals.ca, Nesto.
Rents are actually falling year over year.
Yes, average asking rents are declining. The exact numbers vary, but the trend is consistent across different unit types.
Why is that happening?
Probably a mix of things. More rental supplies coming online, lots of condo completions, more purpose-built rentals being finished, maybe population growth has slowed a bit, and possibly some renters are moving into homeownership now that purchase prices have softened slightly.
And what does that mean for condo investors?
It creates challenges. Falling rents, plus potentially higher carrying costs if they have variable mortgages. It makes it harder to make the numbers work. That could be one reason we're seeing more condo listings hitting the resale market.
Okay, so it feels like the Bank of Canada's rate is just one ingredient in a very complicated stew right now.
Yeah.
How do all these pieces fit together? Rates, sentiment, supply, demand.
It's definitely complex. The usual playbook, lower rates mean better affordability, more demand, maybe higher prices, isn't quite playing out because of this huge cloud of economic uncertainty, especially around trade.
So the sentiment is overriding the rate effect.
To a large extent, yes. Lower rates do help affordability calculations, but people aren't acting on it if they're worried about their jobs or the economy. Rate cuts are supposed to boost confidence, but that trade uncertainty is keeping buyers cautious. Any pent-up demand seems to be waiting for confidence to return.
And prices are caught in the middle.
Pretty much. Lower rates offer some support, but high inventory and weak demand are pushing downwards. If the trade situation gets much worse, there's a risk of sharper price drops. If it eases gradually, maybe we see prices stay relatively flat or edge up modestly.
And you mentioned condos seem more vulnerable.
Yeah, the condo market is facing that higher inventory from new builds and maybe investors selling, plus the softening rental market. Detached homes seem a bit more resilient right now.
Okay, so looking out over the rest of 2025, what are the big overarching things listeners should keep their eyes on to make sense of where the Toronto market might go?
Number one, without a doubt, is that trade uncertainty. It affects everything: business investment, hiring, consumer confidence, even inflation. The Bank of Canada itself admits monetary policy can only do so much to offset a full-blown trade war. So how that dispute evolves, resolution, escalation, just ongoing limbo, is critical for the housing market here.
Makes sense.
Yeah.
Anything else major?
Well, we also just had a federal election. The new government has proposed various housing initiatives, building programs, tax breaks for first-time buyers of new homes, rental construction incentives, things like that.
Will those make a difference soon?
Probably not a huge immediate impact in 2025. These things take time to roll out and actually affect supplier demand significantly. In the short term, the market's going to be driven much more by rates, confidence, and definitely trade.
So bottom line, what's your concluding outlook for the Toronto market for the rest of 2025? For someone trying to make those informed decisions, maybe working through Brad's process.
Okay, near-term outlook. I think we'll continue to see pretty subdued sales activity for the rest of the year. That high level of listings will likely keep it a buyer's market, especially for condos. We'll probably see continued downward pressure on prices, but likely gradual unless the trade situation really deteriorates. Condos remain the most vulnerable to price weakness in that scenario.
And rates.
We expect more BTILA cuts like we discussed, probably down to that 2.000% to 2.25% range. That means lower variable mortgage rates. Fixed rates might drift down more slowly.
And the rental market.
Expect that softening trend to continue: rising vacancy, rents moderating, or maybe falling a bit more.
So the key things to watch.
Definitely trade policy developments. Also how deep and long any economic slowdown is, especially its impact on jobs, and potentially how the government responds with fiscal policy. But overall, expect continued softness near term. Any big change likely hinges on trade news.
So it could be an environment with opportunities, maybe particularly for first-time condo buyers, but definitely requires careful navigation.
Exactly. Careful risk assessment is key. And we might be seeing longer-term shifts, too, in what people want in a home, and, of course, the ongoing challenge of building enough supply.
It's definitely a complex picture. The usual relationship between interest rates and housing is really being bent out of shape by these global trade issues. It underscores how vital it is to understand the bank's thinking and all these economic forces when making real estate decisions now.
Absolutely. And you really need to factor in your own situation, your risk tolerance, your long-term goals when you look at these uncertainties and potential rate moves.
So maybe a final thought for you, our listener, to chew on.
Hmm.
Given that split we're seeing between the detached and condo markets and how much trade policy is dominating things, what specific factors, maybe an economic indicator, a policy shift will you be watching most closely as you think about your own real estate plans in the months ahead?
It's definitely a time to stay informed, revisit these points as new data comes out, and see how that trade picture evolves.
Well said. Thanks for joining us for this deep dive.